perspective. And then there are folks around the country. So my team in Nashville that spends our time across the state in Tennessee, and I work with folks from the Atlanta Fed who cover the whole southeastern United States. We bring more of a boots on the ground perspective. And so we all come together and deliberate on policy in one of those cool ways that can be messy and slower, but ultimately, as we know, diverse perspectives consistently yield better results in the end. So there's a little bit of back and forth and learning as we go. So what are we actually doing? That's who we are. What are we doing? Congress, the U.S. Congress created the Fed. Has anyone here seen the play Hamilton, even online? Oh, so good. Okay, that. Please put that on your list of things to watch. I was like an Alexander Hamilton fan since I was a little kid, so it was very exciting for me to see that come out. So the Fed is actually the third U.S. central bank. The first two were shut down, in part because we have, just in this country, this really deep discomfort with the idea of a centralized authority that has control over the value of my money. One authority that has control over the value of my wealth, of what I've earned working hard. And so the different central banks were started to try to address some of the concerns, and this is a format that has stuck around for over 100 years now. So the Fed was charged with a few things by Congress. One is we regulate banks and try to focus on long-term financial security of the U.S. economy. We manage the payment system, so we're responsible for actually physically managing the supply of U.S. dollars in this country and abroad. And that way we're sort of we're the bank for banks. So you can imagine nowadays your retail bank doesn't have like a big vault with millions of dollars in it. Instead, they try to just keep the amount of cash they need on hand for the transactions they expect to happen today, and they store all the rest of that at the Federal Reserve. And then third is the part that I focus on, and I suspect if you're familiar with the Fed, this is the part you might have heard in the news, is the monetary policy side. So Congress charged the Fed with using its tool, which is monetary policy, to try to balance two things. One is try to create price stability, which we define as an inflation rate of about 2% over the long term, and support a really healthy, strong job market. And to try to achieve all of that with monetary policy, which is different than fiscal policy. What is fiscal policy? It's the ability of elected officials to tax and spend. So most public policy that we tend to think about as a public is fiscal policy. Monetary policy, in some ways, is a singular responsibility that the central bank has. This is our one tool to impact the economy. And I think about it, there are a couple of ways that we do it, but I summarize it essentially by saying the Fed has the ability to set the price of money in this country. And so if things are too hot, if inflation is high, if there aren't enough workers to fill the jobs, if things feel super hot, and you raise the price of money, you raise interest rates, it makes all loans more expensive. Interest rates, the federal funds rate, the interest rate that the Fed targets is essentially the primary rate that all other loan rates across the economy are based off of. So if it becomes more expensive to get a mortgage, or to use your credit card, or to borrow money to buy a new piece of equipment at your business, what might that cause to happen in the economy? It's really hot.
Prices go up.
Prices might go down. Because suddenly I thought, wait, I can afford to buy a house right now. But then the mortgage rate tripled. And I think, I'll hold off. Or if I'm an employer and I thought, I can afford to buy a new piece of equipment and hire a bunch of new people, and interest rates go up. Suddenly I'm thinking, the math doesn't work out so well anymore. Maybe I'll hold off for a little while. and it starts to cool activity. Alternatively, so that's a very crude summary of the environment we're in today. At the beginning of the pandemic, the economy was essentially shut down. There was incredible job loss. There was concern about financial panic. And the Fed dropped interest rates to 0. So suddenly it became cheaper than ever to get a loan to buy a house, or to get a loan to invest in your business, or as a consumer to borrow money to buy a car or make needed upgrades to your home. And it helped to spur activity. And then we became in the environment we're in today. It does not feel like inflation is 2% anymore. In fact, inflation right now is higher than it's been in over 40 years. Is it helpful to define inflation? Would that be helpful? Yeah. This is quite nerdy, but you knew what you were getting into, and you got free pizza, so I'm not going to apologize. So there are prices, and actually over time, when we target price stability, we're actually not literally targeting something costing the exact same number of nominal dollars year after year after year. It used to cost $1 to go to the movies. It's okay that it increases a little bit each year. We consider price stability to be about 2% price increases on average over the years. And when I think about the thing that concerns me, it is less about a one-time price level shift. So that would be inflation, just a kind of one-time blip, and then it would come back down. It's about the rate of change in prices. So it used to cost $1 to get a movie ticket, then it was $1.20, then it was $2, then it was $7, now it's $17 or something. It's the rate of change in price increase. And we certainly have been feeling this. Think about home prices, prices for food, prices for gasoline. We've seen prices go up in a way that are really squeezing American consumers. And I'll get into that in a minute. But one thing that has really caught my eye, I guess there are several. This isn't something we've experienced in this country in a very long time. High inflation is a common issue in countries that don't have independent central banks. If people lose faith in the government's ability to control spending and make sound long-term decisions, that can end up spurring an inflationary environment. But for the most part, we now have people leading households and leading businesses who have never led in an environment of high inflation. And one thing that's really struck me, maybe I'll go back just really quickly, so my own perspective, my work, that is going to inform my perspective today. So when in the dialogue, I'm kind of pulling from all of this work. I have a team of folks in Nashville who are kind of traditional PhD economists who crunch numbers and spit out statistical forecasts. That's traditionally, for the first 90 years of the Fed's history, that's basically how we did policies. You do the fancy number stuff, and it tells you here's where the economy is going, and then you can calibrate policy based on that. But how do you think statistical models hold up when we're experiencing something that's different than we've ever experienced? Not at all. Not at all. Right? By definition, these models rely on historical relationships, right? That's how statistical models work. In this context, where you say, okay, well, traditionally, if tons of people lose their job in 1 month, you're going to see all of these other things. Because we actually have not gone through a pandemic in the era of modern economic data that we rely on. So we could not rely on any of these traditional tools in the pandemic environment to help guide us to what is happening. because it was so different than what we experienced in the past. But that's still an important input into understanding what are the dynamics taking place. Another is we do business and consumer surveys, so surveys of folks' sentiment, how are folks experiencing things out in the world. And then I actually spend about half of my time out in the community. So driving around Tennessee. During the pandemic, it was Zoom, but I'm out and about again, having candid conversations with people who run large businesses, people who run small businesses, people who run workforce development organizations or higher ed institutions, to get a sense of not just what does the data say happened in the past. I want to know how decision makers are thinking about the future. I want to know why they're making the decisions they're making, not just what the decisions are, to help inform how should we be interpreting what we're seeing out there. And I think that's really critical. So in any of my comments today, I'm showing data, but I would say more than ever, our views about the economy that are driving policy decisions right now are based more on input from people on the ground than they are on traditional sources of data, because we know there's just some really wild stuff happening in the data right now. Any questions or? So let's talk about inflation. Inflation is really high. It hurts. We all feel this, right? Is there anyone in this room who hasn't dealt with significant increases in the prices of the things that matter to you over the past year? So what causes inflation at its core? And I actually started with I had a supply-demand curve chart that we have in macroeconomics course up here, and I decided that was going a little too far. If anyone was considering studying economics and hasn't yet, I would probably scare you away. So I decided I should do that. But I do still want to include this concept of supply and demand. That by definition, we need some kind of equilibrium to set a price. And so traditionally, we talked about this earlier, there's lots of pizza over there are lots of hungry people, there's roughly a match right now, the price is stable. If we all come in tomorrow and there's half as many boxes, the really hungry people might be actually willing to pay something for the pizza instead of it being free. What if there's only one pizza and you're really hungry? You might be willing to pay even more. And so what we've had is a pretty intense shock to the economy that caused a really big mismatch between supply and demand. So from a demand perspective, think of it. Consumers had to stay at home. We're getting more support from fiscal authorities than we've ever seen, whether it's unemployment benefits or the supplemental income checks. So not only were you earning additional income, you also didn't have the ability to spend on things that you would traditionally spend on. It's a lot cheaper to cook at home, to talk with family over Zoom instead of visiting them. So when the pandemic shut down so much movement in the economy, consumer savings skyrocketed in a really meaningful way. I mean, in a way that is beyond anything we've seen historically. And in fact, today, those savings are still actually really healthy compared to what you would have expected pre-pandemic. So consumers were in a really strong place financially, and we were also feeling a bit antsy. Look, if I'm going to be stuck at home all day, I have this broken microwave that's driving me crazy, I'm finally actually going to replace the microwave. But we all thought that. And we all went to the store and tried to buy a microwave. But what was happening on the supply front? The pandemic hit that too, right? Suddenly, if you're working in a distribution facility and you pack up microwaves and you load them onto the trucks, and one of your colleagues tested positive for COVID, the operation shut down for 14 days, some number of days. And then the ships. What if your job is to offload ships that come into the port? What if your job is to drive a long haul truck? So many different parts of the supply chain ended up pulling back. And so you saw this significant mismatch between supply and demand, where demand was boosted much higher than usual and supply was held down. And that, at its core, is a driver of inflation, because if there's something you really want or need, you're probably willing to pay more for it. And that's both true for goods. So I talked about it today as if the economy is just a goods economy, but we know the U.S. economy is actually mostly a service economy. So what's the main supply input to services? People. So it turns out a pandemic actually really impacts the supply of people. There both was horrendously a higher rate of death than we historically experienced. We also see people behave differently. If you're a parent of young children, especially a mother with children under the age of 6, your likelihood of having to drop out of the workforce to care for your children was historically high. If you're near retirement age, your decision on the margin, the stock market was strong, your home value was strong, and remember, your savings are doing well. You're not spending as much money as you usually would. And you think, hold on, am I going to go into work when it feels a little dangerous and things feel a little off? Or am I going to be sure I can stay home and stay safe? So there was a mass shift into retirement. That actually is still the biggest factor that has changed in our labor force since before the pandemic, is a big outshift of folks from the workforce who are eligible for retirement. And that's still happening. And also people just reassessed. What does a successful life look like for me? Do I want to be working 3 overtime jobs? What are the opportunities available? So if there aren't enough workers, this is the same as the goods economy, but now we're talking about people. Things open back up. People start traveling. We all want to go to Disney World. We all want to fly. We all want to go to the restaurants. So the service providers see a ton of demand, but they can't find the workers. So what happens to service prices? They go up. And so that's the environment that has brought us to this point. And it's the environment that the policymaking body at the Fed has responded to by really aggressively raising interest rates to try to bring those things back into balance. To show a couple more. See, I get excited about it and I go on too long. Consumer spending still right now, if you look at the demand side of this equation, the demand side is holding up incredibly well. Better than anyone would have predicted a year ago. I don't know one serious economist who a year ago expected its consumer savings, they're being drawn down, and certainly there are folks in the economy who are hurting. But if you look at the economy on aggregate, people are still overwhelmingly financially better off than they were pre-pandemic. Inflation is starting to shift some of that. Inflation is higher than wage increases have been, which means when you adjust for the cost of living, even though you're seeing increases in pay, you're not necessarily seeing as big of increases in your ability to actually go out and buy the goods and services you need. But for the most part, yes?
So as a person in higher education, and there's also a cliff in the number of high school graduates starting in 2025, approximately about 500,000 less high school graduates a year for the next many, many years. How do we ever get to a place where there is enough supply of workers to even out the supply and demand?
Yeah, that's a great question, and it feels like the question of the moment. I think there are several answers. Education is an important one, and I don't have a picture about this today. Actually, there are 2 demographics who have continued to pull out of the labor force, even now, in a big way that's really impacted overall labor supply. And the demographics are age groups. What do you think the 2 age groups are? I mentioned one, retirees.
Yeah.
And it's people, what is it, 20 to 24, 19 to 24. And traditionally, when that number goes down, when those folks participate less in the labor force, it can be a good thing because they're going back to school. But that hasn't been what's been happening at the same rate, which is a real concern. And we know not only is there a need for a lot of people in the future to fulfill the jobs, to fulfill the needs that we have in this country, there's a need for skilled individuals who are helping to propel the economy. And I actually think education is one of the most important answers to that, because we just don't have the number of people to continue to do the amount of manual work that we have been doing historically. And so having folks with the skill sets to engage in automation, to engage in innovation, to deploy technology so that we can be sure that we are doing very well things with one person that it used to take 4 people to do. That has to be a part of the answer, because you're exactly right. There just isn't there's not a sufficient population in this country, and demographics are actually pretty easy to predict. We know how many 24-year-olds there will be in this country roughly next year by looking at the number of 23-year-olds we have this year. So that's certainly a big part of the answer. There's another piece of the puzzle has to do with decisions the country makes about immigration, which is not my area of expertise, but that has been a big factor in the shrinking workforce that we've seen. And there are more employers that I'm talking with who are saying, I would love to hire folks in the U.S. to help with customer service or help with some of these things that I'm doing. I cannot find the folks I need. I would be happy to find foreign-born workers and bring them here or employ them here. That isn't something I can access the way I would need to. So instead, I'm sending the jobs abroad where the labor is. So I think there are some important decisions that we need to make as a country and kind of get out of seeing that as a politicized conversation. And it literally is just a decision of arithmetic. We need this much work to be done, and we have this many people. And being really deliberate about investing in the skill sets and in the education of the folks we have is the only way that this path is going to lead us in a direction where this country continues to thrive in the way that we've been able to in decades past. Yes?
Wouldn't Job Corps help with that?
Will you say that again?
Sorry. Wouldn't Job Corps help with that? Or wouldn't that?
Absolutely. I think there's not a single, so the question was, wouldn't Job Corps help with that? Yes.
Can you repeat his question for people who cannot hear it?
Yes, his question was, wouldn't Job Corps help with that? I think the solution is going to be a yes and approach. I don't think there is one singular solution. I mean, hats off to the leadership here at Chattanooga State for engaging in really innovative ways to think about securing access to education for folks at all stages of life, and that can come in any number of ways. It no longer is either you have a traditional 4-year degree in these areas that you graduate at 21 and you go on to this specific path, and that's what a traditional career looks like. It's much more a patchwork of learning and resources that keep you connected to what are the relevant skills today, and importantly, what are the relevant skills of the future, I think is absolutely critical. Yes?
Do you think that if we had another disruption, like another pandemic, do you think the Federal Reserve would have a different monetary policy than what they did for COVID?
The question was, if there were another big shock similar to what the pandemic was, would the Federal Reserve have a different response based on what they learned during the pandemic? I think philosophically, no. I do think it is important to approach everything with humility and a learning mindset. So I have learned a lot over the past 2.5 years about, I think an example is inflation. a year and a half ago, there were a lot of my business contacts who were saying, this is not going away. This is not about to resolve itself. And there is an inflation problem coming. And I continued to look at the models and I said, okay, maybe that's some of the factor, but once the economy opens up, once schools open back up and vaccines are readily available, some of this has got to open up. People will go back to work. Things have got to start getting better. And some of that happened. And then there was the war in Ukraine. And then there was China's no COVID policy. And then there were big climate events that ended up shutting down port areas. And then there were strikes at ports and for drivers. Now we're dealing with rail strikes. So I think I would hope that any new situation we would come to having taken on board lessons from the past. I think the approach that the Fed took of saying we need to be sure that the pandemic doesn't spiral into a crisis that goes beyond the way it has impacted human life and human well-being into something that creates a really long-term, deep economic depression. And we're going to be aggressive enough so that if we're wrong on being too supportive rather than wrong on allowing that downward spiral to happen. I still agree with that philosophically, but I do think now we have more information about what the line is. And hopefully we can achieve that better. I want to be mindful of the time. I'm available to continue to hang out. I know there's some extra credit, I think, being given to folks for hanging out here. And I will not take it personally if you would like to or have other commitments beyond this. So why don't I